It was indeed a year of gloom and doom for the Indian markets. The Sensex fell 0.6% on Friday, taking the year-to-date loss in rupee terms to 25% and in dollar terms to 37%. The Indian markets were the worst performing among the global indices. This was because of the deteriorating macroeconomic fundamentals and risk aversion due to the European debt crisis and slowing growth in United States. In India, the GDP for the September quarter came in at 6.9%, and economists expect GDP to fall below 7% for the year ending FY12. Also, the fiscal deficit target is expected to overshoot 4.6% for FY12. So, what is the outlook for 2012? Are brokerages overly pessimistic for next year?
It's a case of once bitten, twice shy. In fact, many brokerages have shied away from giving any Sensex target this year. But overall, yes, there is a sense of gloom in the market and among the analyst community. But one thing is for sure that it's the macroeconomic news flow, just like in 2011, that would set the direction for the markets in 2012 as well. Globally, risk appetite would depend to a large extent on how Europe resolves its debt crisis. What is the kind of response that the European Central Bank is going to give? Also, investors would wait for data from the US and to wait to see how strong the US recovery is. And one more wildcard could be China, because many analysts are speaking of a Chinese hard landing, and Chinese authorities might disappoint them by ensuring that there's a soft landing in China. Whatever be the global outcome, the consensus among analysts so far is that it would be a muddle through kind of a world. And for India, it is how it manages domestic economy that will have the most significant impact on Indian markets. Just like in 2011, when the mismanagement of the economy cost our markets, it saw a fall of the rupee as well.
Also, Pramit, the rupee has fallen 16% year to date. It is the steepest fall since 2008 and its worst amongst the Asian peers. Also, several corporates and even exporters and importers were caught off guard, and their profitability took a severe hit. Analysts expect rupee to depreciate further going to next year due to high fiscal and current account deficit. So, what are the other macroeconomic indicators that one should watch out for going into 2012?
The key actually is inflation, because once investors have a sense that inflation is peaking, they would anticipate that with the slowing growth and inflation coming off, the Reserve Bank of India is going to ease rates. And markets would start moving up in anticipation of rate cuts, much before the rate cuts actually happen. Apart from inflation, the other thing to worry about, of course, is, as you point out, the current account deficit. On the government side, the fiscal deficit, because this year's budget, investors, both domestic and foreign, are going to watch both the fiscal deficit number as well as the finance ministry calculations behind it. Because last year, the finance ministry had a decent target, but the calculations were went a bit awry. On the external front, people would watch out for the prices of Brent crude, because if crude oil prices shoot up, the current account deficit widens further and puts a pressure on India's external account. So these are the key factors that would drive Indian markets.